it's Kina. I love seeing all you guys. Anyway, so I have Forest Knott. I'm going to let him tell you about his background. And so he is a lender and he's got some great little hacks that we can use. He's really good at FHA, but he does all kinds of loans. He even does hard money for those that are working with investors. So Forest, I'll let you go ahead.
Thank you so much, Kina. Thank you everyone for joining. It's really an honor to be able to present in front of you. I have been in mortgage banking for, this year marks my 24th year. So I've been through all the ups and downs and, different cycles and programs that have come out, that have been, trending over that time. And I'm hoping that, I know no one here wants to get in the weeds on guidelines, so that's not really what we're going to do. But I'm just going to give you kind of a high level look at some of the changes that are happening to both FHA and conventional loans, and then some of the niche products that surely will be able to get some more buyers and homes. A lot of this I find, I don't know if a couple of the things I'm going to show you, I don't know any realtor that has ever been aware of before learning it. So some great stuff. So I guess if we're ready, we can jump right into it, or should we give it a couple more minutes, Josh?
Go ahead, start.
Okay. All right. And again, I'm with eMortgage Capital. We're a mortgage broker. We work with over 100 different investors. We do conventional loans, FHA, non-QM, hard money, DSCR, commercial, SBA loans, pretty much anything having to do with residential or commercial real estate we can handle. My background is predominantly the non-QM loans, which is non-QM is non-qualified mortgage. So, other than, conventional and, agency and government loans, and, conventional and FHA. It probably, in recent years, it's probably been 70%, conventional, just kind of with the refi boom and all. But I do a lot of the non-QM, FHA, VA, and more so in the last 18 months than a lot of the hard money and DSCR working with investors. So let me see. I'm going to go ahead and share my screen so you can see this. Okay. Does everyone see the presentation says eMortgage Capital Mortgage Hacks?
We see it.
Yeah.
Okay, great. All right, so I'm going to dive right in and just going to start, again, kind of high level stuff. Some of this may be review. Some of it's pretty basic on the FHA, but we're going to dig a little deeper and get into the benefits in a little bit. So FHA, right off the bat, it's easier qualifications as for credit events and credit scores. There's a shorter seasoning period after negative credit events, such as bankruptcy or foreclosure, as you could see with FHA. You only have to wait 2 years as opposed to 4 years from the date of the discharge of that bankruptcy. And for foreclosure, it's 3 years instead of 7 years. So these people can get started a lot sooner. I don't have a slide on this, but the non-QM stuff, it's not going to be as attractive terms, meaning you're going to have to put a larger down payment and going to have a higher interest rate and closing costs. But there are options where we can get a new buyer into a home, believe it or not, 1 day out of bankruptcy, 1 day out of foreclosure. So again, you're going to have all my contact information at the end of this. If you have something like that, I'd be happy to go over that with you. FHA, of course, has low down payments. Conventional also has a 3% down, but it's income restricted, which is why FHA comes in more beneficial a lot of times. We can go down to, with a 580 or higher credit score, you only have to put 3.5% down. But we can go all the way down to a 500 credit score. In fact, I've got a couple pre-approvals out right now with people below 580 credit scores. The only difference there is they have to put 10% down, and there is tighter debt to income ratios also, which we'll go over shortly. So some of the benefits with FHA is sellers can pay up to 6% of the sale price towards some of the buyer's closing costs. More lenient debt to income ratios with FHA, typically with Fannie Mae and Freddie Mac conventional loans. We're going to have max what we call back end ratio, which includes the housing expense plus all other debts on the credit report. Going to be maxed at 49.9%, and you see here we can go up to almost 57%. The first ratio there, the 47% essentially, is the housing expense alone, and then the higher number, the 57%, includes all debts. So this is kind of how we often default to FHA when the client has debt to income ratios exceeding 50%. Non-occupant co-borrowers are accepted. This helps very often with first-time home buyers because sometimes they'll still exceed that 57% if the income isn't there. So we can add an immediate family member to help them qualify. Actually have a couple of those I'm doing right now as well. FHA has lower interest rates and no income restrictions. So it's not income restricted for just lower income. Anyone can do these loans. And in respect to the lower rates, the one drawback with FHA is it had lower rates, but higher mortgage insurance. Granted, it still has higher mortgage insurance. We're going to get into another slide that shows the mortgage insurance has been reduced by 30 basis points as of, 2-3 weeks ago now. So it's very close. And you're going to find that many times, especially for the better qualified client, FHA is going to pencil out better than conventional loans because now the new lower mortgage insurance coupled with the lower rates is resulting in often lower payments than we could obtain with a conventional loan these days. One key thing about FHA loans is we can easily do a streamlined refinance after 6 payments. This means there's no appraisal, no income, and as long as no income docs, and as long as there's been no mortgage lates in the last 12 months or 6 if it was a purchase, and they need the net tangible benefit of lowering the payment, the overall payment by 5%, then they qualify. And that 5% can be combination of not just interest rate, but principal pay down and mortgage insurance. It's generally pretty easy to meet. Now, in the last year, it hasn't because rates have been going up. But another story, rate. I believe at least after tomorrow, we're going to see the peak. And we're going to see rates start declining. So that's going to give a lot of people an opportunity to do a streamlined refinance. The reason I bring this up is unlike a conventional loan, I'm going to give myself as an example. If I am looking to do a purchase and I also want to write off a lot of my income taxes. So if I buy a home before I file my income taxes, then after I buy my home, if I show no income, well, great. I bought the home and I lowered my tax burden. But in 6 months, 12 months, when rates come down, if I want to do that, I'm not going to qualify again. I'm stuck with the rate I get today. FHA, we're not going to look at the income documentation again. Once you've qualified once, you never have to qualify again as long as you are with FHA on that property. So you could show some income, qualify to buy your home, and then show losses on your tax returns. And every time, literally every 6 payments, if the mortgage rates are lower, which is likely the trend we're going to see in the coming years, then you could take advantage of that and incrementally just lower your payment more and more. So great benefit there. The FHA down payment and credit score, if you have a 580 or higher credit score, you may qualify for the 3.5% down payment. If your credit score is 500 to 579, you'll need to put down the 10%. And it does have that tight debt to income ratio, meaning the housing expense can only be 31% of your total income. And total expenses, including if there's auto payments, student loans, credit card stuff, the combination of all that can only be 43% of your total income. That makes it difficult here in Hawaii because rates are still pretty high and the home prices are high. So we can do it, but if the credit score is below 580, it's going to be a little more difficult, where we are likely going to, for these buyers, going to need to add a non-occupant co-borrower. These are some other drawbacks in specific to Honolulu. The max loan limit is $770,500. That's going to exclude a lot of single family homes and multifamily for that matter. Multifamily is higher. I don't have that information up right now. But that's going to put a lot of people restricted to condos and townhomes. Also, if they are at a loan amount higher than $726,200, they're going to have the higher mortgage insurance premium. So instead of being 0.5 or 0.55% of the loan amount for the mortgage insurance, it's going to jump up to 0.7 or 0.75%, depending on if you put 5% or more down. Just something to be aware of. It doesn't make it a bad thing. It's just a little bit more restrictive. Now, anything with an HOA, condos, townhomes, HUDs, must be approved by the FHA. We'll find many have been. If they have not, we can do a spot approval, but that does take time. And when I say that, we're going to be looking for probably a 60-day escrow if we have to do a spot approval. Additionally, there are minimum property standards, which means they're stricter on appraisals. They're going to be more strict than a conventional loan. Lastly, FHA has, and this is everywhere, not just Honolulu, FHA has a self-sufficiency test for 3 to 4 units. So a lot of people love the idea of using an FHA loan to get into a multifamily property with only 3.5% down. Sounds great. It is great. But we also have an obstacle here. The prices are high for those here in Honolulu. And a lot of times, the properties that you're going to get into that are 3 or 4 units, that this would make sense. A lot of these are going to be over on the west side where the rents are also a little bit lower. And what the self-sufficiency test says is the additional units. So if you have a triplex and you live in one, those 2 units need to cover 100% of the housing expense. And if it's 4 units, then those 3 other units, that you're not living in, the rent on those need to cover 100% of the housing expense. That's usually pretty difficult. So just be aware of that. A lot of people want to take advantage of this, but sometimes they get stuck with that, and a lot of people, aren't aware of it. Okay, so this is probably one of the more exciting things we're going to talk about today, and it's how to buy a home with no money. This is going to go over a down payment grant. So the problems with the standard down payment assistance programs are they generally have a debt to income limit of 45% or less, which, as mentioned previously, is a bit tighter. It's going to make it harder for some people. They also have income limits. So that's compounding the problem. So now you have a tight debt to income ratio and your income restricted. Most down payment assistance programs, you need the lender to be approved with that county for that program. And there's so many counties, so many lenders that takes time to find that match. And it's you want to go into escrow, and now we got this whole project to do before. They also take longer for the reason just stated. Because you're waiting on another entity, the down payment assistance program for the county, to approve after you get it clear to close. And one of the most difficult things is they typically have a silent second. So there's a second mortgage recorded on title. Some you have to make payments on, some you don't. But the ones that you don't, or even the ones that you do, typically they won't allow you to subordinate when you go to do a refinance. Even a streamlined refinance, you're going to have to pay that off or wait, typically it's 10 years. So that doesn't help if you get into a place now with the rates high, and then you want to take advantage of these low rates in a year from now. Well, you're going to have to, fork over that 3.5% again, which kind of defeats the purpose. Now with the program that I have available, it's a grant. It's not, there's nothing to forgive because there's no recording of a silent second lien. It's a true gift. The debt to income ratio can go all the way up to 49%. It's a one-stop shop. The lender does the down payment gift grant, so it's all one entity. You don't have to get approved at two different places. So there's no concern, it's going to go through, and these are still going to close in under 30 days. Again, there's no waiting to see if you're approved with the down payment assistance office with the county. The gift wire is sent the title at the same time when the lender sends the closing loan docs. So it's really no different than you wiring your own 3.5% into escrow. And you can refinance and do an FHA after 6 payments, as mentioned. There's nothing to subordinate, nothing to pay off, no restrictions there. You can also sell the home within that after 6, really at any time, and you're not going to have to owe that back. So how we do this with no money out of pocket is, at least right now, in most cases, we can get a seller concession to cover the closing costs. So if you're getting the down payment gift grant to cover your down payment, and you get the seller to cover closing costs, there are 2 minimal expenses that you would be faced with, and that's simply having the home appraised and also a home inspection, which may not be required, but obviously highly recommended. So, you get into a home for, maybe $1,400 or $1,500 considering those 2 items. This is another thing I touched on earlier. The FHA has announced lower mortgage insurance premiums, and that means before, if you were putting down 5% or more, you would have the 0.8% mortgage insurance premium. And if you're putting less than 5% down, you have that 0.85% mortgage insurance premium. That has dropped 30 basis points to 0.5% and 0.55%. So that's just like taking let's say your interest rate was 6.7%, now it's down to 6.4%. That's going to give you more buying power and also put you closer to, that payment on a conventional loan. To put it into perspective, a buyer with a $600,000 loan would now be saving $150 per month over what they would have just weeks ago with the old mortgage insurance premiums. This is just a quick chart showing the difference, and you can see the old here was 80 basis points. Now it's down to 50 basis points. And again, you do see the previous. It was 100 basis points for these larger loan amounts over 726,200. Now it's dropped to 70 basis points. I can send this to anyone interested. Just wanted to give a quick visual on that. Now I want to talk about the changes to the new conventional, what we call loan level price adjustments. So these are based on loan features such as your credit score, loan to value, the occupancy, and most recently, the debt to income ratio. So what we're going to go over now is going to show why now FHA loans have historically been viewed as, I guess, less desirable, meaning if you have a buyer present an offer with a pre-approval letter for an FHA loan, that typically, I know, has been viewed as a lower qualified buyer. And to some degree, that's true. Going forward with these new adjustments, conventional loans are going to be really worse. You'll see in some situations for well-qualified buyers where it's going to be more advantageous for them to do an FHA. And I'm going to show you right now. So the effective penalty for having a lower credit score and lower down payment is now smaller than it was. And in some cases, it's more favorable to have a lower credit score and lower payment. So once again, without getting too much in the weeds, I just want to point out a couple of things. So the green buckets means this is kind of the matrix where we get, our pricing buckets from. The green has gotten better, the red is worse, and the yellow is no change. So if you look at the lowest credit score, bottom left corner, below 639. So credit score below 639, and you need a 620 to qualify for conventional. And the minimum down payment at 97% or even 3% or 5%. In the far right corner, that 1.75%, that is, think of it as like a concession. That's a credit. That's an improvement on the rate. So they're putting the least down. They have a barely qualifying credit score, and they're getting a big improvement. Great for these people. It's going to help more people get into homes. But at the same time, if we look here at the 740 to 759 credit score, and they're putting 15 to 19.99% down, they're getting hit with a 0.75% penalty. This is a risk adjustment. What this translates to on a $500,000 loan, the person with the better credit score putting 15 to 20% down, they would ultimately have to pay $8,750 more to buy down to the same rate that the person, the lower credit score and the lower down payment is getting with no charge. Doesn't make any sense. It's kind of a shocker. I don't have a problem with them helping out the underserved, but why they're penalizing the well-qualified is beyond me, but that's where we're at. And this is what's going to push a lot of these well-qualified clients over to FHA loans. And the reason I want to drive this point home is, as realtors, you need to understand and maybe dig a little deeper and, call the lender and talk about the pre-approval, because many times they're just doing this because it's just a better product for them. This takes effect May 1st, but every lender I know, it's already implemented in the rate sheets because, they need time to get these off the books and, sent to the secondary market. So they're all pricing these in already. There is another hit coming. It was supposed to roll out at the same time. It's being delayed until August 1st, which means that's really going to hit rate sheets probably in June. And that means if the debt to income ratio is above 40%, they're going to have, and this is across the board, depending on credit score and down payment, they're going to have a 1/4 to 3/8 pricing adjustment, a -1 for that. So again, this is conventional only. So now, many times, I'd say more often than not, clients end up with a debt to income ratio between 40 and 50% on conventional loans. So this is going to hit the masses. Another reason why FHA is starting to look more attractive to the well-qualified. Well, everyone in that case. Okay, so that's about all we're going to talk about today on as far as FHA and conventional loans. This is a really neat program. This is a no ratio loan program. It's going to remind you, those who have been in the industry for 20 plus years, of the old stated loans, in the subprime market back in the day. But there are safety stops here to prevent, the kind of disasters we saw before. This is the only program in the nation that requires no income documentation. It's for primary residence and second homes only. The debt to income ratio is not calculated because we don't list any income on the application. The credit's underwritten based on loan to value, the credit score, and liquidity. What I mean by that is they're going to have to put 20% down. So they want to see that they have skin in the game, and they need to show 12 to 24 months reserves. So this is a great program for someone who is asset heavy. That might be someone who just sold a company. They no longer have a business, but they have a lot of money in the bank. This is also great for people that, essentially hide their income, whether it be for, just tax purposes or, cannabis, businesses, crypto, people, all that type of stuff are great options for this. Has a low qualifying credit score of only 640, and we could do these up to $3 million. So when you're talking to your buyers, if their concern is, hey, I can't qualify because I can't prove my income, this is the solution. If they have the money for a down payment and 12 to 24 months reserves, we can get them into a loan. So I kind of went ahead here. So that's 12 to 24 months reserves. Now these rates are going to be higher, but considering where conventional rates are, it's not that far out of the spectrum with rates in the 8% range. And again, for the buyer with heavy assets and, good for people who crypto, cannabis, people sold a company, that sort of stuff. We have other solutions for self-employed borrowers. 1-year tax return. Now, this is actually eligible for Fannie Mae if they have been in business for 5 years. So this is great for, let's say, someone who's been in business for 5 years, but the year before last was a really bad year, thinking about COVID. But last year was a fantastic year. We only need to look at 1 instead of 2 years. So that's a great product. I don't know many I've talked to that are aware of it. We also have a 1-year 1099 only program. So the income documentation is a single 1099, and that is how the income is calculated. We also have a P&L only program. Now, this does need to be prepared by a licensed CPA, but we all know businesses have, their P&L for tax purposes, and then they have the real P&L. We just want to see the real P&L that shows, not all the excessive deductions that they're going to take for the taxes. And then, most people are familiar with the bank statement programs. We can do personal or business bank statements. The neat thing here is kind of just like the 1-year tax return program. We can do it with only 3 months bank statements. So once again, if someone has kind of had a bad year overall, but the last 3 years, or excuse me, the last 3 months took off, well, that's all we need to look at. And they can not stress over the fact that the first 9 months, they maybe didn't have any income. We do still need to prove that they have been in business self-employed for 2 years, but we only need to look at the performance for the last 3 months. Hard money, it's pretty aggressive. We have for experienced investors, and this does not restrict. We can work with less experienced investors, but this one is calling for 8 flips in the last 36 months. We can fund 90% of the purchase price and 100% of the renovation up to a combined total of 70% ARV. So in most cases, that's not a problem, the 70% ARV. These are also a 13-month interest-only program, and rates actually start in the 9s on this one. So pretty aggressive for hard money. DSCR, again, it seems more realtors are now more familiar with this, but it's really important here in Hawaii because we have so many people wanting to invest in Hawaii. DSCR stands for debt service coverage ratio. So it's simply based off the credit report and the appraisal. With the appraisal, they're going to run what's called a 1007 rent survey. And that is basically just, in addition to finding comparable home values, they're going to look in the neighborhood for comparable homes that have what the average rents are. And that's what you qualify for. Typically, we want to see a 1-to-1 ratio, meaning that the rent services the debt, meaning if the mortgage payment is $3,000, the rent is at least $3,000. We do have some investors. I've got 26. We've got some of them that will go down to 75% debt service coverage ratio. And a couple, although they're not the best terms, will actually do no ratio. And even with a vacant property with whether that's referring to refinance. So of course, no income required, no W-2s tax returns, no lease agreements are required, but we can use a lease agreement if, let's say, there is current tenants in the property that you're buying and the rent survey comes in lower and the lease agreements are higher, we can use that in place of the rent survey. It will override it. Again, no job, no employment listed. We could do interest only, adjustable rate mortgages, 40-year fixed options, and of course 30-year fixed. And we can do these all the way down to a 600 credit score, believe it or not. These do require minimum 15% down. Last summer, I was able to do these with only 10% down, and odds are that's going to come back. Probably by the third quarter, we're going to see 10% down for these DSCR loans. Loan amounts up to $5 million, so it should cover just about most stuff in Hawaii. 3 to 6 months reserves are required. First-time home buyers are not eligible, but you can be a first-time investor. They just want to see that you've owned another property in the last 7 years for at least 12 months. These, again, for an investor, it's going to greatly reduce unnecessary stress and anxiety. These typically close in 2 weeks or 72 hours after receiving the appraisal. It's pretty much underwritten, looking at the credit day one, and then as soon as we get the appraisal back in, assuming there's no issues with the value or the rent survey, then it goes in line for docs. So very easy loan for investors who, again, have a hard time documenting their income or have too many finance properties, etc. This is a really neat one for our investors. I know all of us love the idea of veterans moving to Hawaii, and they might only be here for 3 years, but we encourage them to buy real estate here because it's going to be a great long-term investment to build their generational wealth. But a lot of times it's a one-shot deal and they stop. This is a way that we can get them to retain their prior residences that they might have used their VA entitlement on and continue buying a new one each year. So if they've already used some of their VA entitlement, they can use it again. VA entitlement does vary by state and county. So when they move to Honolulu, it's going to be among the highest. So that'll increase their entitlement. The VA entitlement does, if they don't have enough to cover 100% of their purchase, they only need to come up with a 25% of the difference. So let's say, hypothetically, it's a $1 million loan and they only had 300,000 remaining. Well, they only need to come up with 175,000, not 700,000. I know it still sounds like a big number, but it is, still doable. This is the hack. So if they don't have enough VA entitlement, they don't have that 25% difference, they don't have to sell the home from their departing residence. We can free that up by refinancing into a conventional loan. So we get that off their entitlement, and then their new purchase can go into a VA loan with nothing out of pocket again. So we can do this every 12 months. So that's kind of our way to tell these veterans, hey, let's buy you a home a year. And when you maybe leave Hawaii in 3 years, you've got, 3 investment properties in Hawaii. And then we continue helping them going forward, wherever they relocate to. So Couple last things about some unique options, particularly here in Hawaii. Especially this helps some retired people. Or again, the person who has maybe just sold a business, is cash rich, no income. We've got asset depletion as a standalone income or just a strengthened income. So let's say someone is retired and they're only getting Social Security and that's not enough, but they have a couple million in the bank. We can use that money to offset, the debt to income ratio to help them qualify. And we could do it entirely off their assets. So if they're of retirement age, we can use 70% of that asset divided by 36. If they are not of retirement age, we use 100% of that cash asset total divided by the loan term. We have a foreign national program. Now this is for investment properties and second homes. So this has been popular with some of my clients that are Japanese that want to buy an investment property or a second home in Hawaii. They only need to put 25% down, and we can use the international credit report, or if not that, those are expensive, typically a couple $100. We can use alternative credit, which we get letters from 3 creditors in their country, showing that they've been in good standings for the last 24 months. Non-permanent resident alien program is standard Fannie Mae guidelines. They just need to have a green card, work visa, I-10, DACA. Most people are probably familiar with this, but again, it's often forgotten because this is, they're going to be able to qualify the same way as a U.S. resident would for that. And then the I-10 program, individual tax identification number, for people not eligible for Social Security numbers that do live here in the U.S., they only need to put 20% down to buy their primary residence, and of course, full documentation. So they don't need a social, don't need to be a U.S. citizen, and do that for them. That's really all of the stuff I wanted to go over with you for today. I wanted to share this is something my company has just rolled out. We have a personal assistant program where we can outbound and basically call your old dead leads. Any lead source will outbound as your assistant, and these are all sorted, of course, by the referring agent. They'll have their basically own database within our database, and they will get routine calls, texts, emails, and once we kind of resurrect them and bring some new interest, then of course the first step is to help them get pre-approved, and then they get referred back to the referring agent with pre-approval in hand to go shop. Again, wouldn't expect this for a hot lead that just came in, but most agents I've talked to have, if they've been buying leads, have a large database of past leads that just never went anywhere. Maybe they never even reached them, and they're really not doing you any good. We're happy to cultivate that for you. And that's all I have for you today. I hope that was beneficial. Just kind of high level stuff. If anyone has any questions or a specific scenario, well, I'm happy to answer what we can now, but this is my contact information. You can simply scan that QR code, and that's going to allow you to save all of my contact information. It also has links to all my socials, my Zillow reviews, all that stuff. I do put out educational videos on finance and real estate each week. And yeah, I'd be happy to help in any way that I can, get some more business to you.
Hey, Forrest, I think Jenny, she raised a hand. She may have a question.
Yeah. Hi, Jenny.
Forrest, thank you for the seminar. I'm working with some retirees. What products would be best for those clients?
Well, I'm always going to default to looking at, agency conventional or government loans, FHA or conventional. That's going to have the best terms for them.
Okay.
If they can qualify, keep in mind, when they're retired, we can typically gross up their Social Security income by 15 to 25%, depending on if we're going with conventional or FHA or VA. And a lot of times that'll help. If not, then we might want to look at, the no ratio program if they have the assets for that.
Okay.
That's typically the best ways to go. Or the asset depletion. The asset depletion or asset as income, piggybacked on a Fannie Mae loan would be best if that's good. They're going to get the best terms that way if their fixed income is not sufficient.
Okay.
But I can run some quick numbers and kind of tell you where they'd be at. If you have some information on them, or if you put me in touch with them, it wouldn't take long to do.
Okay, great. And then are there any kind of down payment assistance programs for any retirees or?
Oh, absolutely. The one that I went over, the down payment grant is really the go-to. I mean, I've been doing this 24 years. I've never seen one more attractive than that one.
Okay.
That would be the first stop to see if they qualify for that. On that point, there was something I unintentionally left out. There is a catch to it, the down payment grant. Now, if they are, so this one lender is going to give you that 3.5%. There's no clawback. There's no repayment. There's no payments on it. But they need to make their money somewhere, right? So the catch is on a conventional loan, FHA loan. Elsewhere today, they're probably going to be somewhere around 6.25%, putting 3.5% down. This is going to have an interest rate of 7.75%. So it's going to be a higher interest rate. It's going to be higher payment. But again, I don't have a crystal ball. I don't make guarantees, but I'm happy to send anyone, information on, what is strongly expected that's going to happen. We're probably going to see another quarter rate hike tomorrow. Maybe it's 50-50, but with these banks falling, and I'm confident we're going to see more fall in the near future, that's going to force the hand of the Feds to start lowering rates again. And rates will start coming down. I believe we're going to see May rates come down, whether it's May, June, July. We're inevitably going to see rates come down this year. And I can feel very confident telling these people that 7.75% is only going to be 6 payments, and then you're going to reduce it. I'll be frank. I was going to use that program just recently on an escrow I was in, and it was roughly an $800,000 purchase. I was going to get $29,000 gifted to me. My payment was roughly $1,300 to $1,400 higher per month on that size transaction. I could afford that payment, didn't want to live with it, but by doing that, that was going to get me, just shy of $10,000. That's how much more I was going to pay over those 6 payments. And then I do a streamlined refinance to a lower rate, where my payment would drop $1,300, $1,400 a month. And then I can further do a streamlined refinance as rates drop further. That was based off today's rates. But as you can see, that's a net savings for me over that first 6 months of $20,000. So that's a catch. It's going to be a higher payment for 6 payments. As long as they're comfortable and can afford that, in my opinion, it's a win. Additionally, they do charge a 2-point origination, which you typically aren't going to find on an FHA loan. That's where, again, the seller concession, we can have up to a 6% seller concession, which is going to be more than enough you're likely not going to need that much to cover that 2 points plus all the other closing costs, including the prepaid items such as the seller concession can go towards homeowners insurance, property tax, your initial escrow deposit, and prepaid interest. So it's key to work with, so to build that into your purchase. In fact, Kina helped me with mine, and we needed to be aggressive. So I wasn't asking the seller to make the concession off of the purchase price. We just bumped up the purchase price to give myself that concession. So there's always a way to make it so, even with those two things, with the higher closing cost, get the seller to pay for it. And again, as long as they can stomach the payment for 6 months, it's a great win. They're going to basically save about 2/3 of what they would otherwise by making that 3.5% down payment alternatively.
Awesome. Thank you so much.
You're welcome. Does anyone else have any questions I can help with?
Josh is checking.
Okay, yeah.
Okay, so I think that's it. All right, thank you so much, Forrest. And I think y'all, did you scan his code so you can get his contact info?
Not yet.
He's awesome because he will actually try to connect with the leads you throw him, not wait for them to be served on a silver platter. So I would definitely connect with him. He's awesome. Thank you so much, Forrest.
Thank you so much for the opportunity to share with everyone. And like I said, I'm happy to help. If anyone has any questions or just want to kind of brainstorm different ideas, whether it's just for future business or if you have a client, feel free to reach out. I'm happy to help.
All right. And then I have a question here. Someone would like a copy of the slides. Steve, can we get the slides?
Oh, absolutely. Yeah.
Right.
Again, if you just reach out using my my QR code there, and I'll email that out to anyone that likes it today.
Okay, cool. It's actually Josh, but okay. All right. All right. Thank you so much. And I'll see you all later.
Thank you, everyone. Have a great day.
Thank you, Kina.
See ya.
Bye-bye.